Did you know that mutual funds are the most popular investment vehicle in America today? Some 46.4% of US households own mutual funds, with a combined asset value of all funds totaling over $17.7 trillion. But could your mutual funds in fact be putting you in the poorhouse? Well, maybe. And here's why. As you're probably aware, there are two basic types of mutual funds: managed funds and index funds. An index fund's portfolio matches the components and the total annual return of a financial market index, such as the S&P 500. But that's not necessarily a good thing. Why not? Because when you invest in index funds, your fortunes fluctuate with the ups and downs of the broad markets. That leaves you vulnerable to volatility and the invariable market crashes. For instance, in the crash of 2008, investors gave back nearly $8 trillion in wealth to the market. In 2020, whipsaw volatility once again triggered anxiety and fear among many investors, as the broad markets took them on a stomach-churning roller coaster ride. With index funds, your wealth is at risk, because protection of capital simply is not built into mutual funds. And what about managed funds? Well, the sad fact is, most money managers just don't do very well when it comes to picking winning stocks. In fact, 7 out of 10 managed mutual funds consistently underperform the broad markets. Also, no fund manager or investor, even top performers, stay on top forever. For instance, Warren Buffett has seen his Berkshire Hathaway shares underperform the broad markets for almost a decade. What's more, with a staggering 9,599 mutual funds to choose from, picking the right funds for your investment portfolio can be a difficult and research-intensive task. Perhaps worse are the outrageous fees you pay to own mutual funds, fees that many investors are not even aware of. For instance, when you put $100,000 into a mutual fund, the fees could total between 2.5% and 4.5% annually. But when you invest in private lender notes, your fees are zero. Zilch. Nothing. Nada. These fees can be a huge drain on your mutual fund accounts. For example, say Sam invests $100,000 in Fund A, while Joe invests the same amount in Fund B. Both A and B generate an average annual return of 10%. Annual expenses for Fund A are 2%, and for Fund B are 1%. After 20 years, Joe, who owns Fund B and pays 1% annual expenses, will be $1 million richer than Sam, whose Fund A charges 2% annual expenses. What's more, mutual funds have a major tax disadvantage. The fund manager trades stocks in the portfolio throughout the year and does not need your permission to do so. When specific stocks in the portfolio are traded at a profit, accounts are subject to capital gains tax, even if the fund as a whole incurs a loss. That means you can lose money, and yet still have to pay taxes. If that sounds unappealing, let me introduce you to an alternative asset: private lender notes. With high yield, super safety, and zero annual fees, private lender notes generate consistent annual returns of 6% to 10%. In sharp contrast, the questionable performance of so many fund managers result in the majority of managed funds underperforming the market. There are zero fees for private notes versus the 1% to 4% and higher annual expenses for mutual funds. Outrageous fees that can rob you of hundreds of thousands of dollars in gains. On the flip side, one advantage of mutual funds is that they offer you a diversified portfolio of stocks. With private lender notes, you're investing in a single asset. But the stocks in your mutual funds portfolio can plummet without warning. By comparison, private lender notes never depreciate, ever. And here's why. Max return private lender notes are backed by hard assets, specifically a large portfolio of prime residential real estate our company owns. This collateral means that you will never lose even one thin dime as an investor in our private lender notes. That's because the collateral assets are worth at least 25% more than the total value of the notes we issue. So, if needed, we can simply sell some of our assets, ensuring that every investor is paid back in full. Principal plus yield. No ifs, ands, or buts. That way, return of your principal is 100% guaranteed. Again, because the value of the hard assets backing up our notes is equal to or greater than the price of the notes themselves. Best of all, secured private lender notes from Max Returns enables the average Joe to diversify into real estate with a passive investment that eliminates the headaches of buying property and being a landlord. Next, we urge you to take a look at our additional video lessons. They compare private lender notes to financial instruments, including stocks, T-bills, bonds, CDs, rental properties, so you can make the investment decisions that are right for you. Just click below to choose your next free lesson and watch the video now. You'll be glad you did.